Hi everybody, and welcome back to my channel. Today we are going to be talking about ICR loans, which is a type of student loan repayment plan that can help you reduce your monthly payments. I'm Melissa Ford. Welcome to Damsel of Success, where we talk about all things money. Please be sure to like and subscribe and hit the bell to be notified when I post a new video. So let's talk ICR loans. This is the last of my series of videos that cover income-driven repayment plans that you can use for federally backed loans. And the ICR loan I'm doing last for a reason, and that's because it's not a great option. It's only a great option, I'm going to tell you this right away in this video, if you're working with PLUS loans made to parents. Otherwise, I would highly suggest that you consider a different repayment plan because this one is a little bit more tough than some of the others. So let's get right into it. First of all, I want to tell you what an ICR plan is not. It is a long-term plan, so it's not temporary relief like deferment or forbearance. Those are things that you might consider with your loan servicer if you have a temporary setback. This is a long-term program. So in the case of an ICR plan, we're talking about a length or a repayment terms of 25 years, as opposed to a standard loan repayment plan where you would pay off the loan in 10 to 12 years. An ICR loan is also not loan rehabilitation, which is something that you would pursue if you were currently in default on your student loans. And doing so would help you kind of get back on track, take you out of default, and get you ready for one of these IDR programs. But it's not that. So ICR stands for Income Contingent Repayment, and that's because the amount that you would pay every month flexes based on how much your income is. In the case of an ICR loan, that amount is based on 20% of your discretionary income. And unlike a standard repayment plan, this particular loan lasts for 25 years, meaning you'll be paying off your loans over the course of 25 years. So what are the benefits of going with an ICR loan? The first benefit of an ICR loan is that loans like PLUS loans made to parents actually qualify under this repayment plan. There is no other repayment plan where those kinds of loans qualify. So this would be your only option if you're looking at something that was paid out to parents. And the only other positive thing that I can say about these loans is just a tiny detail, and that's that if you're married and you choose to file your taxes separately rather than jointly, then your spouse's income would not be considered as a part of the calculation to determine what your discretionary income is, which if you have a spouse that is making more money than you could be a big factor, but you're definitely going to want to consult with a tax expert before you make that kind of decision, because obviously there are a whole bunch of repercussions that could happen based on how you file your taxes. So that's something you should consult a professional on for sure. But you should know that with this ICR plan, filing jointly is an option for you to avoid including your spouse's income in what is calculated as your monthly payment. The best thing about an ICR plan is really the best thing about all of the IDR plans, and that's that if you reach the end of the term of your loan, in this case 25 years, if there's still a balance left on your account, that balance is 100% forgiven. So if you pay for 25 years and you still owe $10,000 on your student loans, well, the government says, nope, you don't owe that anymore. It's completely gone. However, there is a little caveat to that, and that's that any amount that's forgiven is added to your taxable income for that year. So let's just say, as an example, that you have $10,000 forgiven and that you're in a 25% tax bracket. Who knows what you'll be, at this point, but we're just going to use 25% as an example. In that case, $10,000 would be added to your income for that year, which means that you would have to pay $2,500 in income tax for that amount that was forgiven. So if you are on this plan and it's looking like you might have an amount that would be forgiven, then it's probably a good idea to plan ahead and save up for that tax bill, which could be significant depending on the amount of your student loans. So what are some of the reasons that you might not want to consider an ICR loan? Well, frankly, there are quite a few. First of all, it is the most expensive of all of the income-driven repayment programs, meaning that when it's looking at what you can afford to pay each month, it's going to calculate that at 20% of your discretionary income. All of the other plans, meaning the income-driven repayment plans, range from 10 to 15%, and most of them fall in that 10% range. So this is double what you could potentially be using for another program. But like I said, if you have a PLUS loan made to parents, this is your only option in terms of adjusting your repayment plan. Another thing to consider is, again, with the discretionary income calculation. So with all the other plans, they take the federal poverty line and they multiply it by 150% to determine a calculation for your discretionary income. And we'll get into the weeds and really look at an example of how to calculate your discretionary income in a moment. But for right now, what you need to know is that unlike the other IDRs, the ICR is calculated at 100% times the federal poverty line. And so not only is it higher in percentage of what it considers you are able to pay in discretionary income, it also lists your discretionary income at a higher amount because you can subtract less of the federal poverty line to get there. Another downside of this loan is that unlike other IDR loans, your interest is capitalized. So what does that mean? Well, basically you can think about your loan as having two different buckets of money that you owe. The first is your principal balance. So the amount of money that you actually took a loan out on. Let's call that $45,000. The next bucket is the interest that is accruing on that loan. Let's just say that $10,000 of interest accrues every year on this loan, which is astronomical and not correct, but just for cases of example. So you have $45,000 in this bucket and $10,000 in this bucket. Well, when loans are capitalized, essentially what happens is that those buckets get combined. And so the total amount that they are charging interest on includes your principal balance as well as any interest that is accrued. And that is what happens with these ICR loans. Most of the other loans keep those things separate. But with an ICR loan, you are continually raising the amount of your principal balance at which you're charged interest. So the only way that you can avoid paying interest on your interest is if you are paying off the full amount of interest every single month. Another downside of this loan is that your monthly payments aren't capped. So what does that mean? Well, when your payment is capped, and that happens with a couple of the other IDR loans, but not the ICR, when it's capped, that means that you'll never pay in a month more than you would have paid on a standard repayment plan. So if your standard loan repayment was $500 a month, you would never pay more than that, even if your income rose. But with an ICR plan, that's not the case. So if your income rises and your discretionary income obviously rises with that, well, then you could potentially be paying more every month than you would have under a standard repayment plan. So in our example, if we were at $500 a month with the standard repayment plan, you could conceivably go up to $550 or $700 or $1,000 a month, depending on what your income is. It still, goes up and is calculated based on your discretionary income. So it's meant to stay affordable to you, but it might turn out that if you end up making significantly more money, well, then, your payment is going to rise as well. And there's no cap to how high it can rise. Like all of the IDR loans, there are a couple other downsides as well. And mostly that's that when you stretch out that repayment plan over the course of 25 years, like you do with the ICR, the total amount that you're going to pay is going to, be a lot higher. And that's because interest accrues. And like I said, in this case, when interest is capitalized, that rate goes up significantly. So what you'll pay over the life of the loan can get pretty high. With an ICR, there is another downside, and that's that with that 25-year repayment period, chances are pretty good that you're not going to have a loan balance that's forgiven, which means that you're kind of losing out on the primary benefit of this loan, which is to have, an amount forgiven of the loan after a period of time. But the likelihood is pretty strong that you will be able to pay this loan off before you get to the point where any amount is eligible to be forgiven. And like I mentioned before, if there is an amount that's forgiven, it will be added to your taxable income and you will have to pay income tax based on that amount. So now let's talk about what makes you eligible for an ICR loan. Now, the good news about an ICR is that the eligibility requirements are fairly low compared to all of the other IDR plans. This is one of the more easy programs to qualify for. And that's obviously because the benefits are lower as well. So in some other loans, you might have to do a couple of things like be qualified as what's called a new borrower or demonstrate partial financial hardship. You don't have to do that with this loan. But like all IDR programs, the loan has to be federally backed. Privately backed loans don't qualify, and you can't be in default on your student loans. So if you are in default, then you're going to want to look at something called the Loan Rehabilitation Program instead. And that program is going to get you to a point where you would be eligible for one of these IDR plans. So like I said, there is a wide range of loans that are eligible to fall under this program. I'm going to put up a chart here, but this is the most lenient of all of the IDR loans. This one is the most lenient in terms of what kind of loans qualify for the program. So eligible loans are direct subsidized loans, direct unsubsidized loans, direct plus loans made to graduate or professional students, and direct consolidation loans. And if the loan is consolidated first, then the following are also considered eligible. So that includes federal Perkins loans, direct plus loans that are made to parents, subsidized federal Stafford loans from the FFEL program, unsubsidized federal Stafford loans from the FFEL program, FFEL plus loans made to graduate or professional students, and finally, FFEL plus loans made to parents. So obviously the biggest perk of this program is that if you're looking to reduce the payments on, a loan that was made to parents, this one qualifies for that. So, this is the option that you have to select from. It's the only option, but there is an option. So that's a good thing. The biggest question on your mind is probably how much are you going to pay every month for an ICR, program loan? Well, there's a formula that you can use to calculate that pretty simply. I'm going to put this formula up on the screen, but I'm also going to go through an example of it in just a moment. So if you feel like I'm rushing, don't worry, we're going to go through this again. In order to calculate your monthly payment for an ICR loan, you would take your AGI, which stands for adjusted gross income. And if you're confused about what that means, just look at your 1040 tax return, and on page 1, line 11, your AGI will be listed. So you're going to take that AGI and subtract whatever the number is for the federal poverty line. And we'll get into how to figure out what the federal poverty line is for you in just a second. But you take your AGI, you subtract the federal poverty line, and then you multiply that balance by 20%. That is going to give you your discretionary income, what this program determines to be your discretionary income. But that balance is for the whole year. So in order to get your monthly payment, all you need to do is divide that number by 12.
Now you'll see that there's an asterisk here, and that's because this loan has one little benefit to it, and that's that it's going to take the lesser of the result of this calculation, or what you would pay for this loan under a standard repayment plan over 12 years.
So like I said, I know I just threw a whole bunch of terms and math your way, but we're going to go through this on a more detailed level in just a moment. But first, I want to go through what the federal poverty line means, because it was a little bit surprising to me how low it actually was. I've talked about this in previous videos, but that federal poverty line is extremely low, and I don't know how anybody could possibly survive on it, to be honest. So I'm going to put up a chart right now, and this is how you can find your federal poverty line. So the federal poverty line is the same in all areas except for Alaska and Hawaii. So if you live in either Alaska or Hawaii, you need to consult your state to figure out what your federal poverty line is considered. But as you can see on this chart, your federal poverty line goes up as your household size goes up. So we're going to take a look at just like if you're a single person and your household size is 1 and you don't have any dependents whatsoever. So in that case, your federal poverty line number would be $12,760. So how someone could survive on that number, I have no idea, or even like a little bit higher than that number. I don't see it, but that is the number that we have to use for this calculation. Okay, so now that we have that information, let's dig in on a real example, like a real life example of what this could look like. So for this example, we're going to make a few assumptions. So first of all, we're going to assume that you are single and have no dependents. We're going to assume that you live in the lower 48 states, not Alaska or Hawaii.
We'll say that you have a $45,000 student loan, which you'll repay over a period of 10 years at a 6% interest rate. You'll see in a moment that that 10-year repayment period actually ends up being pretty significant in this scenario, as some loans are given under a 10-year repayment period and some under a 12-year repayment period. And that'll make more sense as we go along.
We're going to say for this example that your AGI, or adjusted gross income, is $40,000. And we're going to assume that on average, you're going to get about a 5% raise every single year, which, by the way, is based on a study that was done by the Federal Department of Education and the Federal Department of Treasury to find out on average how much of a raise you could expect as a college graduate over time. And they found that the average was 5%. So that's the amount that we're going to use in this example. So now that we know the numbers that we're going to be using, let's plug them into that formula that I mentioned earlier. I'm going to again put this up on screen so you can follow along. The first thing that you're going to do is take your AGI and subtract that federal poverty line number, and that will give you a balance of $27,240. That is what is considered your annual discretionary income. Now, as we talked about with an ICR loan, your monthly payment is based on 20% of your discretionary income. So what you would do is take that $27,240 and multiply it by 20%, which would give you a balance of $5,448. And that would be your total for the year that you would owe. So in order to get your monthly payment, you would just divide that number by 12, which would give you a monthly payment of $454 a month. So we got to a total of $454. Now here is the interesting thing. The amount that you would be paying on a monthly basis under a standard repayment plan would be $361.45. So since that payment is lower, under these circumstances, you would actually pay the lower amount under the ICR plan.
So because in our scenario, the original payment plan was over 10 years as opposed to 12 years, this actually ends up being a pretty significant difference. But if your original loan was set up over a period of 12 years instead of 10 years, like in our scenario, well, unfortunately, this wouldn't make any difference at all to your monthly payment.
But it does take the lesser of the two. When you're considering whether or not to go with an ICR plan or any of the IDR plans, I want you to take into account more than just that monthly payment, because there are other factors that you really need to consider as well. So going back to our example scenario, let's take a look at how this loan would play out over time. So as we discussed, your first payment on this loan would be $361. Over time, as your income increases, your payment would increase as well. And so your last payment on this loan would be $428. Under that repayment plan, it would only take you 14 years to pay off the balance. And in total, you would have paid for this loan $68,503. This might be a good fit for you, but you have to run your own numbers to figure that out. And luckily, the federal government has actually made this pretty simple. They have a loan calculator on their website, which I will link to in the description below, and you can enter all your own personal details, your own AGI, your own student loans, and it will calculate on your behalf what the different scenarios would look like for each one of these repayment options. So you can kind of compare the terms and see what's going to be best for you and what's more important to you. Is it more important to you to pay off the loan sooner? Is it more important to you to have a lower monthly payment? Or is the total amount that you're going to pay over time the most important thing to you? That loan calculator is going to give you all of those answers. It's going to show you which loan fits best for you under all of those scenarios. And, that way you can make the decision, you can make the call about what's going to fit your life the best. So what else do you need to know about an ICR? Well, there's only really one other thing that we haven't talked about a whole lot, and that is that you need to recertify this loan every single year. And that's not difficult to do. Your loan servicer will reach out to you to request the information that they need to recertify you for this program. But it's really important that you respond to that and give them the information that they need, because if you don't do that, then you might be subject to some penalties, and those penalties are not great. The first penalty that you could be assessed under the ICR plan is that right away your payment will go to whatever your standard payment amount would have been under the standard repayment plan. So if you're currently paying $350, for instance, a month, and the standard repayment plan amount was $500, well, your payment is going to go up to $500 right away. The moment that you do not recertify, when that expires, your payment is going to go up. The next thing that can happen is that instead of taking into account any dependents you might have previously claimed, they are going to reduce your family size to 1, as if you're single with no dependents. So that's just how they calculate it if you fail to give them the information that they need. They just automatically take you down to being listed as a single person with no dependents whatsoever. So that could also cause your payment to spike. So it's really, really important, like I said, that you recertify this loan every single year. It's a little bit of a pain, but you have to keep on top of it. The good news is that if something changes in your circumstances, you can actually recertify this loan at any time. So if you have a baby and add another dependent, or if your income goes down, if you switch jobs and have a lower income, all you have to do is reach out to your loan servicer and they will recalculate what your payment is at any point. It doesn't have to be on an annual basis. Now, of course, if your payment goes up, you don't really have a lot of motivation to reach out and contact them and tell them that information. But if you think there's a chance for your payment to go down, you might as well reach out and see if that's a possibility. So you've gotten to this point and you've gotten all this information about an ICR and you're saying, this is the right fit. This is the kind of program that I need. So how do you get an ICR loan? Well, that's actually really simple. It's the simplest part of this whole thing. And that's that you just reach out to your current loan servicer. That's all you have to do. Whoever you're making your payments to now for your student loans, you just give them a call and they are willing to work with you to get you onto one of these programs. They are totally familiar with these programs and absolutely willing to put you on one, because it's not just a win for you, it's a win for them too. It's a lot better for them if you continue to make smaller payments over time than if you're overwhelmed by your monthly loan payments and just stop paying altogether. So they are motivated to make this work for you and absolutely willing to put you on one of these plans. So like I said, all you have to do is reach out to them and they will walk you through the process and request the information that they need from you to get you qualified. So hopefully this has given you all the information you need to make a good decision, a good financial decision about your student loan repayment plan. And hopefully that helps you meet your financial goals, whatever those goals may be. If you're into talking about financial goals, if you're into talking about personal finance, then I hope you go to my channel and check out some of my other videos, because that is what I talk about all the time. That is what my channel is all about. So I talk about investing, I talk about retirement, I talk about early retirement if you're trying to make that happen. I talk about debt repayment and goal setting and how to really optimize your finances to make sure you can reach the financial goals that you have. So take a look at some of my other videos if that's of interest to you. And if this video was valuable to you, please hit the like button. That helps me out a lot. And if you'd like to, see my videos on a regular basis, please hit the subscribe button and hit the bell and you'll get a notification every time I post a new video. Just simple as that. I will be posting another video about personal finance next week. In the meantime, I hope you have a wonderful week. That is all for now. Bye-bye.